Welcome back everyone to another episode on our learning series. Today we're going to talk about the GDP. Without further ado, let's get right into it. So GDP also stands for Gross Domestic Product, whereby it measures the total value of goods and services produced in a period. So basically, it actually measures how much the economic makes and sells, indicating or act as a report card to say, hey, whether or not if this current situation of the economy is very active, had a lot of production, sales activities, or it's just very cooled off without any or less economic activities. For example, if we have a high GDP value, this actually indicates that the economy is actually in a phase whereby it is actually pretty good with a lot of activeness, including high productions, high trades, high buys, and high sales, which will also brings up the confidence of the consumers in terms of buying or the current situation of the economy. And usually high GDP will result in high inflations, which in our previous video, the high inflation also means high CPI, which will actually drive the Fed to increase the rates. So this is actually to cool off the economy before it becomes more expensive and balance out the situations. And as in contrast, which is low GDP, this actually indicates a very bad economy whereby there is less activity in terms of production, less sales, less buys. So it will reduce the confidence of the buyers, which will reduce the production as well as reduce the act of trading. So the difference between CPI and GDP is that GDP actually tells you how fast your car is driving. And for CPI, is tell you whether or not it is overheat or too cold. So these two actually helps with each other in order to understand the current situation of the market, and then the Fed will actually react towards it and decide whether or not it is to increase or decrease their rates. So let's go to some of the example of today's example of Malaysia's GDP. So over here we can observe the Malaysian GDP actually went to negative, and this is actually where the time of 2020 of COVID-19, and then after a few months, so on and so forth, we managed to see that the economy GDP of the country actually went up again. And also right now the GDP is actually at a very low compared to recent years. For example, the 2022, we're currently sitting at 4.4%, and we also wish to see an increase in GDP in the future, while at the same time being able to maintain the CPI, which is controlling the inflation and increasing price of the goods. And another example is going to be the GDP for US. So this is a advanced GDP quarter by quarter graphs, and you can actually see there is news in between if you actually focuses on the market, whereby there is a possible recession due to a negative form of the GDP value. So what they say is that if there's a 2 consecutive quarters of negative GDP, actually indicates that the market is actually in a situation of recession. But for the latest one in July 30, we get a result of GDP at 3.0, which actually indicating that hey, the market is actually kind of active back up again. The market is starting to grow, have more productions and sales activity going on in the market. So there's a lot of things that we can also obtain from just the GDP value, as we mentioned, whereby we have a high GDP indicates that economics are very good, a lot of confidence, while at the same time, high GDP means that the activity of the whole economy is actually increasing due to active production, buy and sales. This also means that the company has high earnings. Earns a lot from this high and active economy itself. So it will also provide more jobs and also has more salary or more bonuses, commissions, which will actually result in a high confidence, which will consistently drive the active of this economic market. And as for low GDP value, means that there's less economic event, less production, less sales, meaning that the company actually earn less earnings. So in order for the company to have profits or to earn from this little portion of revenue and growth, they will actually try to reduce their costs by what? By laying off employees, meaning that less jobs. So with less job, there is less salary, which will reduce the confidence of the buyers, which will actually result in less economic activities, less sales, less buys, less productions. In these two scenarios, what is the solution towards both of them? So if the economy is too good, there might be inflation, there might be high CPI. The result is to increase the rates. What if in bad economy, so people are less in terms of spending, there are no confidence in the market, so meaning there are less people who are willing to buy. So in this situation, the Fed maybe will consider to cut their rates, which will eventually makes lending, as our last episodes of CPI, more cheaper, which will also drives the market. So it will allow people to spend more because of less rates, less cost in terms of borrowing, which will try to expand the company itself. So let us see how does actually GDP can work together with CPI in order to understand the current situation of the market, because the information alone itself cannot tell much, because there can be a situation whereby there's low GDP, high inflation, low inflation, high GDP, a lot of cases. So for example, here in our first scenario whereby we have high GDP and high CPI, so meaning that the activity of the market is very active, a lot of production, a lot of sales being made, and at the same time there is possible a very high increase in terms of product prices, which eventually leads to a high inflation. So in this case, it's actually leading that it will actually wants the market to sort of like cool down. So the results of Fed making decision is they are more likely to increase their rate. So as we mentioned, that if there's high CPI, and since the market is also in a position whereby there is a lot of activity, you want to cool down the market. So in order to reduce or also prevent that the inflation situation keeps going higher and makes the spending become more expensive. So in the second case, it's called the lower GDP as well as low CPI. So meaning that the increase in terms of price is very low, so the product is increasing in the phase very slowly, and GDP market and low GDP also indicates that the economic activity is also very slow, less productions. So in order to deal with this situation, it's very easy. Fed will likely to reduce their interest rate. So this reduction of the interest rate is a catalyst in order to stimulate the market. So with less rates, we have cheaper lending options. It will actually help the business to expand their company, their manufacturing, and provide more jobs to the market, which will actually start to heat up the economic status. So let's look at the example 3, whereby we have high GDP and also low CPI. So this is a very good case whereby we have a very active economic status, very active, so which is good. And if low CPI means that the price of the goods are increasing slowly, so it's kind of like cheap, but it's just that it's increasing at a slower pace so that the price of the goods is not that expensive at the same time. So this is in a very good situation whereby the market will continues to grow because of very active economic status as well as low CPI, which can be leads or caused by a low inflation. So this situation is whereby the Fed will likely to hold on to the situations, or perhaps to cut the rates in order to stimulate more spending from the consumers in order to heat up the market and perhaps increase the CPI. And the fourth one, which is kind of like a worst case whereby we have a very low GDP and high CPI. So this is what they call a stagflation. So this is where the activity of the economy is very slow. Less production, less buying and selling activities. However, the price of the product is also in the case of increasing. Okay, the price of the product is very expensive. In terms of this situation, the Fed is very confused because of the decision that they need to make. There is no direct decisions, because if you want to deal with, let's say we want to deal with the low GDP, since there is less economic activity, you want to stimulate the market, it is best for you to cut rates, right? But these cut rates can eventually make more spending, which can result in a even higher CPI. Okay, but if you increase the rate, let's say scenario 2 whereby you increase the rates, there is going to be less spending, and it's sort of like slowing down the market, whereby it will continuously contribute and making the GDP even lower and slow the market even more, despite it can help with the CPI value. So this is the worst case that the market can be in, and we hope that the market don't actually be in this situation which can directs the market, cause a lot of short-term panic in terms of stocks price, and only then the gold as well as the oil will be some safe haven for that time. So basically from these four scenarios, we have this first case whereby the stock market, because of increasing the rate, the stock market might actually have a short-term pullback before going higher at this point of time. And in case 2, there is CPI cooling, whereby we still also have a very low GDP, which can also be meaning that the activity of the market is not that active. However, it can be a very consolidation movement and eventually go up if the news of decreasing the interest rate is being announced. And as for the third case, which is the best case, whereby we have a very active economy, while at the same time a possible situation whereby we have a rate cuts in order to drive people to spend more and maybe balance and slightly increase the CPI, whereby this stock market is going to be in a very suitable and very comfortable environment for the growth of company. And as for the last one, which is stagflation, this is where market can panic and also results in a recession. So short-term movement down is a possible result. That is why they say hedging against the market by buying gold is actually one way to go too. So yeah, I guess that is all for today's video about the GDP. If you're interested, you can actually go deeper into using these factors, one of the economic factors, in order to understand more of why there is movement in the markets. And if I missed out anything, you can actually share it down in the comments below. And I hope this video helps you out and you would like to support me. You can click the thumbs up, share the video, and also subscribe to my channel. And I hope this helps. See you on the next one. Goodbye.